excited. This is actually kind of self-indulgent for me, as I would like to get more, I don't know, proficient or more experience with covered calls. Now I do my own fair share of covered calls, and I know I've seen you around Twitter for years now talking about them. So I'll just be happy to pick your brain a little bit. And I've had a lot of people that have asked about covered calls and wanting something done on it. So that's what we're doing here. And I see we have a few people already, and I'm going to just put this up here because we're going to talk about covered calls, pick his brain. Jeremy, by the way, from Dividend Stockpile. It'd be nice to introduce you. God. And yeah, so he has dividendstockpile.com, super knowledgeable guy, and happy to have you back. So we're just going to jump right into it. And first off, what is your definition? What is your way of explaining? Now, okay, I will say this could be a little bit, it took me a couple weeks to just really get the basics of covered calls down. So this is probably going to be for people who have just a little bit of an idea about them. So with that being said, what are covered calls in your definition? What are covered calls?
Yeah, that's awesome. Well, so I've been doing covered calls and other types of options trades for a few years now. Prior to that, I was really just a straight buy and hold dividend investor, pretty straightforward. And I was introduced to covered calls and other options a few years back, and a light bulb went off. It was, absolutely amazing that there's this product out there that you can do this on. So ever since then, I've been going really hard at it. So a covered call is a type of options contract. And so I'm going to try and break it down as easy as possible. But a call is where you give someone the right, but not the obligation, to either buy or sell you something. So a covered call is where you would be selling someone else, a random person, the right, but not the obligation, to buy shares that you already own at a certain price by a certain date. And so that's what the contract is. And as the seller of the covered call, you are in control of the contract terms. So for instance, if I have 100 shares of Coca-Cola, ticker KO, and I feel comfortable that I want to give someone the right, again, but not the obligation, to buy my shares at a certain price in the future, they're actually going to pay me what's called a premium to do that. And I, as a seller, get that money up front, no matter what happens with the underlying stock. Doesn't matter what happens with the contract, but I get that money right away. And so I can use that contract premium, the money that's received, to either buy more stocks, by doing more options contracts. I can do whatever I want with the money. I could take it out and spend it if I wanted to, but I get that money up front.
Yeah, so it's yours. I want to just reinforce that. So when you sell an options contract, that money hits your account. Now you are locking yourself into a contract with those shares, but that money hits your account immediately, and it is yours to do whatever you want with. So that's obviously one of the really big selling points on that.
Yeah. So in covered calls, there's a bunch of different contract lengths, prices you can choose, premiums you receive. So really, you get to tailor it as a seller to what meets your needs. You can do weekly sells where it would expire the next Friday. You can do monthly. You can do 3 months. You can do years worth of contracts. You can do it like a year out, 2 years out, things like that. I highly wouldn't recommend that, but the options are yours as the seller to pick your terms. And so that's what I really like about covered calls. So to break it down a little bit further, in order to write a options contract for a covered call, you have to own increments of 100 shares of whatever company you're looking to sell. So if you only have 50, 75, obviously you would have to build up. And I know you're working on that with PepsiCo to get to that 100 share requirement. Yeah. So once you have 100 shares and you're willing to sell it, then an options contract and a covered call might make sense for you. Again, you are writing a contract. You are obligating yourself to sell those shares if the contract terms are met. And so I guess I can break those down as well.
Yeah, so there are ways, and I'll just add that you are locking yourself into that contract, and you can buy it back. You can do something called rolling it into another contract, roll it up and out. I mean, that might be a little bit advanced for what we're talking about. So I guess we'll build on top of what you were saying. So what are a few of the main things that you look for? I guess your main criteria, or what you sleep well at night. What do you look for when you are about to, or looking for a covered call to write? And then I guess on top of that, you could also, what are a couple of your favorite stocks to um, sell covered calls on?
Sure. So because you are signing up for a contract, you have to be willing to lose your shares if it happens. If it's a company that you want to keep your shares, there's no way in the world you would ever want to get rid of them. Covered calls wouldn't be the right move for that particular holding. So before you even start anything, you have to decide, is there a stock that I would be okay selling at a certain point in the future, and at the price you determine, but you wouldn't lose sleep at night because you lost those shares. So if you have something that you've held for 10 years and you're up 500% on the shares, you may not want to use that as your covered call, because if it does go against you and you do have to sell your shares, you would pay the capital gains and you would lose that cost basis, and you'd have to go back and buy the shares again at the current price. So before you
Right.
pick any stocks, you have to think about, am I okay getting rid of this? Because as an option seller, you will have contracts go against you, and you will have to sell your shares. So
Yeah. Yeah.
I tend to like to do weekly options, so I keep my option
Really.
period really short. I find that I have a better idea and understanding of the price movements of the stock during that time frame compared to a month or 2 months or 3 months. It's harder to judge what the market's going to do. But in a week's time, 5 to 7 days, you have a pretty good sense that a stock is only going to go up or down a certain amount. Of course, there's always crazy times like the last couple of weeks where the volatility is high, and what you thought would never happen happens, both the upside and the downside. But you have to be willing to get rid of it. One of the great things, again, is as an option seller, you are setting the terms. So you would never set the sell price lower than what your purchase price was. So if I bought Coca-Cola at $50, I would never sell a covered call at 48, because I'm automatically going to lose $2
Yeah.
different. You always want to set your contract price at a higher price than what you bought it at.
Yeah, and that's very key, because I always talk of it, or say it's a win-win for me. Now,
Mm-hmm.
the downside is missing out on the upside, I guess, as a way of saying it.
Yep.
Like my Altria shares, I'll use that one as an example. So when I was selling that, what I like to do is I look at recent highs, and I try and go out, usually like 3 weeks, maybe a month. And I guess it's a little more risky, like it was with that. And I pick those resistance points where it's probably going to test, but might not break. And I get more money for doing that usually, but it is a little bit more risky. But still, point is that it was above my average share price. So even if the shares got called away, which they did, I got paid $126 or $1.26 a share for selling that contract, which I got to keep right away. And then I think I still made, I want to say my average was right around $47, $48 a share. So right there, overall I made over $500. So
Yes.
it wasn't bad. And now, if anyone who follows the channel, and I've talked about on the podcast, is that I play around with it. I say I got my Altria dividends early because I sold the opposite of a covered call, which is a cash secured put, and I did that for $50, which I chose that, and it expires actually Friday, which I'm kind of sad because I don't think it's going to hit that, and I want the share. I want to get back in, and it's the reverse of the covered call. So I have to have that $5,000 because that was the strike price that I'm trying to buy at $50 a share. And
Yeah.
that's basically selling insurance to somebody, because if something crazy happens this week and Altria goes to $25 a share, guess what? I still have to pay that person who I bought the contract from, or who bought it from me. I'm basically insuring their shares. I would have to buy those shares at $50 a share, even though it's worth 25. So it's
Yep.
kind of protection for them.
Exactly. Yeah. So with a covered call contract as well. So you're expecting when you sell a contract for the share price not to go over that whatever dollar amount you picked. The buyer of the contract is hoping that it does go over that amount because they'll make the difference between the strike price and the current value. So if I, again, with sticking with Coca-Cola, if I had it for $50 and sold it at $52 strike price, and Coke goes up to 60 during that term, the buyer of that option can then take my shares at $52, and then he or she automatically has a value of $60 per share. So they made $8, and that's why a buyer would buy a covered call option contract, is because they're expecting the price to go up higher than what they're willing to pay for it. But as the seller, we're taking the opposite approach. We have the shares, we're okay getting rid of them for a certain price, but in order to sell that insurance or that contract to someone else, we get paid up front, which is great about it.
Yeah,
I'm,
no,
al-
that
I'm
makes
always
sense.
always a seller, never a buyer of options. I like to be in control.
Yeah, you're basically being the casino, right? You'd rather be the
Exactly.
casino than be the gambler in the casino.
Got it.
And
So
yeah, go ahead, finish that
So
thought.
because we're trying to explain kind of how it works. So when you log into your brokerage account, you have to apply to trade options. So you have to go and check to talk to your broker, whether it's calling them up or going online. You will have to sign up for it. They'll give you certain level access, and that access allows you to do cover calls and cash secured puts and more advanced methods. But once you get that set up, you'll have access to what they call an options chain. The options chain is a list of all the contracts that you can pick from. So going back to Coke, if it's $50 right now, it'll give me a range of contract prices from say $35, $36, all the way up to $100. And the buyers and sellers present bids to this marketplace, this options chain, and it will determine, okay, this person is willing to sell this particular company at this price and would accept X amount of premium or payment upfront to do it. And so there's this whole list of options out there, and you get to pick which one you want to choose. I can pick a $52 strike on a $50. I can do a $60 strike. I can do right at $50. I get to pick what I want to sell it at. And based on that strike price, the dollar amount I'm willing to sell it at, I get paid upfront. The closer that strike price is to the current price of the shares, the higher my premium is going to be, the more money I'm going to get upfront. The farther away, the less money I'm going to get. And at a certain point, if you get too far away from the current price, no one's willing to buy that. And
Yep.
so the price will be zero. No one's willing to give you any money for a $100 Coca-Cola share when it's going at 50 today. So you have to be realistic on what you're willing to sell and also what the market will give you.
A great example talking about that. AT&T comes to mind. I specifically 2 years ago started going heavy into AT&T so I could sell covered calls. And
Mm-hmm.
right now, and this will be the next question for you. So some of my AT&T shares are right around $30, $31 a share, and the share price is what, 22 something, almost 23. So
Yep.
it's damn near impossible for me to get anything more than maybe like $2 or $3 total,
Mm-hmm.
complete total,
Mm-hmm.
for not selling below my average share price, which it's tempting. It's
Mm-hmm.
tempting to do that, but that's one of my rules I'm not breaking. So what do you do? Is there anything you do? Do you just play the waiting game? Is there any way,
Mm-hmm.
any tips, tricks you have that if
Sure.
your average price is significantly above the current share price, is there anything that you do?
Okay. Yeah, so there will definitely be situations where it doesn't work out in your favor. One of the things that's out there that you'll start looking at when you look at the option chain is a thing called delta. Delta is a representation of the percentage odds of the contract going against you. So you'll see a delta of 0.5, 0.2, 0.1. That is the buyer's chance of it going in their favor, meaning they'll make money. So a delta of 10 means there's a 10% chance that the buyer will make out in the deal, and a 90% chance that me as a seller will make out on the deal, meaning I won't have to sell my shares. And so when you're looking at the options chain, look at the deltas to get a sense. It's not exact, things happen, but it gives you a good realistic percentage of what are the chances of it going for you or against you. So I have two different types of options that I play. One is shares that I have, like Pepsi or Coke or Johnson and Johnson, companies that I'm going to have anyways, and I want to make a little extra money while I'm holding those shares. So I don't want to necessarily get rid of them, but I want to make a little money on the side while I hold them. And in those instances, I would pick a strike price, meaning a sell price, at a much higher amount than what the current price is. So I think Johnson and Johnson is around 150 or so, right in that ballpark right now. So because I don't want to sell my shares, I might look for a 160, a 170 strike price. The chances of that Johnson and Johnson hopping that high during my contract period is pretty low.
Yep.
So in that particular instance, the delta will be very small, meaning my percentage of chance of winning is going to be relatively high. Based on that, I'm not going to get a lot of premium. To Russ's point, you might get a few dollars here, a few dollars there, depending on the price of the stock. But it's very low chances of you losing the shares. So you get a little extra money and you still get to keep your shares in most instances. So for companies like that, that I have that I plan on keeping forever, I'll do a very far away from the current price, strike price, just to gain that little bit of premium and not have to worry about losing my shares.
And those are weeklies that you're doing usually?
I do weeklies, yeah.
Yep.
I find that, again, I can better get a sense on the way the market is going and my odds of the stock not hopping up. A lot can happen in a month. So if you do a monthly contract, things can happen. So you'll get more money up front by doing a monthly because you're obligating yourself for a longer time period. But, if the stock goes way up, you might lose out. If the stock drops, you might, work against you. So I tend to not like the longer terms. The general philosophy out there is most people do 30 to 45 days, but I found that the weeklies do better for me. So that's what I do.
I was going to say the ultimate in that, where you said the longer out you go, the more premium you get. I did this with Neo, the Chinese car, the EV car company. Unreal what happened, and those who listen to the podcast, I detailed this quite extensively. So Neo had been dropping and dropping from like $12. I bought a bunch of shares when they IPO'd in 2018. They were all the way around $3 a share, and at this point I was like, they're probably going bankrupt. They're going to go to zero. So I sold. They were optionable, so I sold an option for I think $7 or $6. And all of a sudden, as soon as I did that, they turned around and the EV bubble started inflating and they started going up. Before that contract expired, they were at like $8, $9. So I rolled it up and I did that like 4 or 5 times. And at one point, Neo was at $66 a share. And the highest I went was $20, which oddly enough is now below that. But that's something crazy that can happen. And I couldn't catch up because I was so far out. At one point, I was almost, I think, a little over a year out, and I just ended up waiting. I said, I'm going to let what happens with it. I'm going to add real quick, Steve, I'm going to take this question right here that he asked about, because I can answer this really quickly. So this will depend on your broker. I believe Robinhood is free, but I use Charles Schwab, and Charles Schwab is 65 cents per contract, and it's both ways. So when you sell it, and then if you buy it back, so you're going to get hit. I mean, it's really small. It's less than 1% or something. So that would factor in for me if I was selling a contract for $4 or $3. 65 cents of that is going to go towards Charles Schwab. What about you? Do you pay any commission fees or?
So I do all my options with Fidelity, and it's 65 cents per contract as well.
Same.
Unless it's a really small contract. So if it's under like $1, they're not going to charge you.
Oh, okay. I didn't know that.
Like,
really?
Obviously, we haven't really talked about it, but when you buy things back for a penny or something, the total cost is only $1. They're not going to charge you for that.
Now, I couldn't do that. Sorry to cut you off. I couldn't do that this week. I had a Realty Income call that was expiring, and all week it was at like 2 and 3 cents. But they said under a certain amount, I had to do increments of 0.5, 0.05. So
depending on the stock, yeah.
Yeah, so I didn't, because I'm I'm frugal, and I knew it wasn't going to hit $70 because that's what it
Yeah.
was for. I didn't want to pay the extra $3 to buy it back, so I waited till Friday and it expired worthless. So is there any way around that? Do you run into that at Fidelity where there's a minimum and you can't buy it back for less than like 5 cents or something?
Yeah, yeah, exactly. That definitely happens. It depends on the stock you're doing the options for. One stocks that are highly liquid that have a lot of options contracts, you'll be able to do it by the penny each contract. Some that aren't as liquid will require you doing 5 cent increments. And when we talk about cents, that's per share. So remember, everything we're talking about is times 100 shares. So 1 penny a contract would be $1. And so and so obviously we're talking about these low dollar amounts, and that's what happens when you do contracts that are what they consider way out of the money, meaning that the contract price is way off from what your purchase price is or what the current stock price is. But there's another way of doing options as well, covered calls, and those are for times where you don't care if the shares get taken away from you. A lot of people buy and sell options just for the premiums that they receive. They don't actually really care about what stock they're holding. They're just doing it for the premiums. And when you operate like that, let's just say that you want to buy Coke, it's at 49.50 right now, and you're willing to sell it for $50. You don't care if the shares are taken away from you because the only reason you're in it is for the premium that you receive up front. So by doing, if you buy it at 49.50 and you're willing to sell it at $50, you're going to get a much higher premium up front. You might get $50 just to do that 1 week contract. So you get 1% of the value just that 1 week because the purchase price and the strike price are so similar. So there's multiple ways to sell covered calls. I do both of those. I sell covered calls on the companies I want to hold for the long term, and I'm willing to take a smaller premium, those $8 premiums, the $10 premiums, things like that. But for other companies that I'm just doing it for the options premium, I can get 1-2% a week return on those type of things because I could care less if the company gets sold out of my portfolio or not.
Now, does it factor into your decision at all that those would be short-term capital gains if you just
Yeah,
you bought it on, a week ago and then it gets called away, you still have to pay the short-term capital gains on those?
yeah. So anytime you sell an options contract, no matter if it's on a company you've held for 10 years or a company you bought last month, the options premiums that you receive, the cash up front that you receive, is always considered short-term gains. So that $10, the $50, the things we've been talking about, you're going to get short-term capital gains, and that would be taxed at your normal tax rate. Um, Now, the underlying company, let's just say that I've held Coke for 5 years and I end up having to sell my shares. The difference between what my purchase price is, my cost basis, and the strike price, and that would be the considered short-term or long-term capital gains. Just that difference between the buy price and the sell price, depending on how long I've held the shares, you might have to pay capital gains on that. But the options premium itself is always considered short-term capital gains. So
Yeah.
I keep that in my mind, and at the end of the year, I'm going to get hit with a 20-25% tax hit on those options trades. But as long as you know it's coming, you can set the money aside and it won't be a big deal. Now, you
Yeah.
are
Yeah.
able to do these in an IRA as well. And if
Yep. Yep.
you sell options in an IRA or a tax advantage account, you don't pay any capital gains. And so that's a huge benefit. You get to keep all your money on that one and just reinvest it for the long term. So
Yeah, and that's was just great point because I have our self-directed IRA and the Roth, and I sell covered calls. The Realty Income was in the self-directed IRA,
mhm.
so that was yeah, that definitely was beneficial for that. And I lost my train of thought. I had a really good thing to say. It'll come to me.
So,
What is your biggest lesson from covered calls?
yeah. Just like as a dividend investor, when you chase high yield, you're going to get burnt. Same with covered calls. When you chase high premiums, you're going to get burnt. There's a reason why someone's willing to pay you a large amount of money. We're talking 4 or 5% premium for a week's contract because of the volatility of the stock. They're expecting the stock to shoot to the moon, as they say, and they're going to make a ton of money. So they're willing to pay you that much money up front. But remember, if something can go up, it can also go down. Volatility works both ways. So you might get a 4% premium up front, cash into your pocket, but the stock tanks 10% that same week. And you're
Yep.
sitting there holding the bag on a stock that you can't sell anymore because you just lost 6% in a week. And so that's been my biggest takeaway. And I'll share one in particular. I not got caught up, but saw the juicy premiums on the ARK funds. Particular, I did ARKG, the genomic healthcare one. The
Mm-hmm.
premium was like 3% for a week. And of course, outside of my wheelhouse, that's not what I'm comfortable with. I stick to dividends,
Yep.
but I was like, ooh, this looks good. Let me do it. Immediately lost 10%. And, at that point, you might have made 3%, but you lost 10%. So you're down 7. So my takeaway is be conservative. Don't chase the high premiums, and do it on companies that are actually cash flow positive and making money. Don't do options on companies that aren't making any money. I'll just put it that way.
Yeah, and then you get stuck. Like you said, you're stuck
Yep.
holding shares of a company that you don't really want to own. You were just trying to get the premium, the options
Exactly.
premium.
Yeah.
And
So
yeah, go ahead.
my apologies. When I'm selling shares for companies that I want to keep for the long term, I shoot for approximately a 12% return a year. So
Okay.
when you look at the premiums, if you're doing a monthly, obviously divide that by 12. So you look
Mhm.
for 1% of the price of the options is what I'm looking to
Cool.
get on a
Cool.
monthly basis. And so that was very conservative. Again, we're not looking to make a ton of money in the options. We just want a little extra cash. So maybe 2% a month is realistic, very conservative. And you're not going to lose your shares very often because you're taking at high strike prices. But if you're doing the type of covered calls where you don't care if the shares are taken away from you, you're just basically churning them over and over,
Hmm.
you can realistically make between 24 and 48% a year. So 2 to
Yeah.
4% a month selling options contracts. And that's still very conservative. You're not looking at these high flyers that, the Palantirs of the world and, SoFi and things like that are going up and down like crazy. These are on stable, boring companies, but because you're selling the contract at a price so close to the current price, people are willing to pay you. So you can easily get 2 to 4% doing this strategy over and over.
Yeah, and there's a lot. There's if anybody's a little bit lost, don't worry. Feeling lost when this is new is
Mm,
completely and utterly normal.
yeah,
You're
yeah,
kind of supposed to. It just takes time,
yeah.
repetition, getting in and doing it, and then YouTube. I mean, there's so many. I didn't even try, but if you just were to type in how to sell covered calls or what are covered calls, I mean, you're probably going to get 100 different videos.
Hmm.
So
Uh,
yeah, I love it, man. Just
so
fantastic discussion.
shameless
Yeah, go
shameless
ahead.
plug. I
Yeah.
do have a couple articles on my blog, Dividend Stockpile, that I do talk about how to do covered calls, and I do go in depth both on dividend payers, non-dividend payers, the different types. So the ones that you're willing to sell right away, as opposed to the ones you want to keep long term. I do have a couple articles out there. So Russ, I appreciate that. Definitely
Yeah.
feel free to reach out. You can also find me on Twitter, same tag, Dividend Stockpile, and we can definitely go into more detail. I know there's only so much we can say right here on the live stream. So
Yeah. Yeah. All right, man. So I think we're good. We got a lot of information out there, and I remember what I wanted to say. I wanted
okay.
to, I wanted to say that I'm not too worried about paying tax on a gain,
Mm-hmm.
and if you have a loss, if you can tax loss harvest, which we won't get into that, but yeah, I mean, yeah, taxes, they're going to get, you're paying taxes one way or the others, but paying taxes on a gain, not too worried about that. So let me back up here and get on some of these comments here. Let's see a good one. A lot of good evenings. There we go. Rebecca says, thanks for teaching us newbies. You are very welcome, Rebecca. There's one for you, Jeremy. Easy. Let's take it. We'll clear up palettes here. Yeah,
There we
Terry
go.
says, hey.
So Terry and Rebecca are part of a Facebook group that I'm a part of. So hey guys.
All right. All right. All right. We got Blue Collar Bill. He's been around for a while. He just had 100 shares of KR called away. Is that Kroger? No. Is that
Kroger.
Kroger?
Mm-hmm.
Okay. He didn't expect to
Yeah. So
jump like you did. Hey, Bill,
even
if you're still watching, let us know what strike you had. I'm just curious what strike you had. Let's see. Let's see what Steve said. Yeah, we went over that. Let's see. There he is. Shamir, back from Canada, having a can of Coke right now. That's fine. You know, it's funny. I was working with a guy today and he was eating Frito Lays, and I had to stop and thank him for his contributions to my dividend income. And he
Yeah,
had no clue that PepsiCo owned Frito Lay. He thought I was pulling his leg, so he actually had to Google it. And so
that's what
the beauty of dividend investing, look at
exactly.
that information. I know guys 5 years older than me had no clue. No clue.
Yep.
Let's see. We went over the commissions. There you go. Terry said that TD is 65 cents too. Now here we go. This is really cool. I like this from Maximino. Mino. He's really ignorant in covered calls. That's why he invests in Divo, Jeppy, and BST. And
Absolutely.
absolutely, if you have no clue what you're doing, you pay a small expense ratio, which I think Divo is what, 0.55 maybe? 40.45,
Um,
0.55, I think.
yeah, 55, I believe, and Jeppy is 0.35.
Yeah, so you can pay people to, you're still getting exposure to covered calls. You're just having people that do this for a living know or should know what they're doing.
So yeah, so
Uh,
Divo and Jeppy obviously are great cover call ETFs. As Russ said, they do it for you. You won't get as much premium as if you would do it yourself.
yep.
You're going to get a return just on the distributions of between 5 and 8% a year. But to let someone else do the work for you, that's a great way of going.
Yeah, yeah. Yeah, I guess not. We always have some more to add on that. But yeah, with Divo, what I liked about them is that I was looking into them that they invest in like high quality companies, dividend growers, so they're not just trying to capture that premium, like you said, with Palantir or Neo or something like that. That could be really volatile. So that made me feel really well about that. Let's see. Kind of went over this selling leap covered calls on stocks you own 9 months more or out for high premium. Yeah, for me, it is really tempting to do that. Oh, and you know what? I did do that. Last year, I sold a leap. It was 1 year on Altria, and I think I got maybe 160, 170 for it. And then Altria started just dropping and dropping and dropping in price. And I think I bought it back for like $30, something like that. So I still
Yeah.
made well over 100. And I bought it back maybe 6 weeks later. That's how fast it just, that it just got eaten up. So that's something you could do too. And that's more risky. And you know, anyway,
Yeah.
you can always buy it back, and
Yeah. Just
that one it
remember,
worked out.
you're selling a contract. You're obligating yourself to do what the contract says. So if you're obligating yourself to sell X stock, 9 months from now, you're taking a risk of the unknown happening. Let's just say you have a stock that's worth 100 and you sell a 9 month out contract for 120. You're capping your upside to 120. What if the same stock goes at 200?
Yeah,
So when you go farther out, you're giving the buyer more opportunities for it to go in their favor than going in your favor as a seller. So I like keeping it short. And I said again, I like to do weekly, maybe 10 days out total. A lot of people in the community do 30 to 45 days. I've never done a leap because I don't know what's going to happen 9 months from now. I don't want to take on that obligation.
yeah, that's fantastic. And yeah, I remember reading once they said that if you are buying a call option, you should go out as long as you can and just pay the extra money because there's more time for your thesis to play out. But when you're selling, you want as short as possible where you're going a week. So that's not much shorter than that.
Yeah.
Let's see. All right, Rebecca, thank you. Very interesting live stream. That's love to hear that. Let's see. How many IRAs can you have? I believe you are unlimited in how many IRAs you can have. You just hit a maximum amount that you can contribute. So,
Yep.
take a Roth. I believe the Roth is still what, 6,000 per year.
Yep.
So I believe then you could theoretically have 6,000 Roth IRAs and contribute $1 to each of them. So I don't think it matters the amount. So it's just the contribution amount is what you're capped at, from what I understand.
Yep.
Oh, here, this is one I joked around with. Terry want to know, can you do covered calls on ETFs that you own too?
Absolutely. So actually, one of the things I do most of my covered calls are on ETFs because I like the stability of an ETF. Obviously, if you have an ETF that has 100 different companies, 200 different companies, the volatility of that particular ETF is going to be a lot less than a single stock. And so one of the big ones I do most weeks is the financial services ETF. It's called XLF. Sorry, that one is all the financials, and so I do that usually on a weekly basis. There's also XLV, which is the healthcare one, XLP, which is consumer staples. So there's a lot of ETFs that you can do cover calls on. Absolutely.
Dropping the knowledge. And I'm going to look into these as soon as we get done here. Because, hey, I love it, man. I love the ideas. Thank you. I
And on
have a few
those,
more. Yeah, go ahead.
sure. On those, you can get 0.5% to 1% a week on those ETFs. So it's a very low risk way of doing it. As long as the overall sector that you're doing that ETF on doesn't drop significantly, then you'll do pretty well.
All right. Marvin says he doesn't personally do covered calls, but he dabbles a bit in ETFs like JEPI. He respects all the work and insight Jeremy does. I applaud that. I do too.
Well, thanks, Marvin. Appreciate that.
There we go. Shamir, he was talking about with my PepsiCo owning Frito-Lay, and they're helping his stocks. Yeah, actually, and then there was a second guy today who was using dip. He was chewing, which I think is a nasty habit, but hey, he's over 21 and he enjoys it. So he was using Kodiak, which I don't remember who Kodiak is, or I'm sorry, who owns Kodiak. It's probably Philip Morris. It's one of the big companies, but yeah, I asked him if he ever uses On, because that is, or not On. No, On it is Joe Rogan. On, I think, is Altria product. So he said he tried it. When he's working inside somewhere all day and he can't spit, then they use the nicotine pouches because you can swallow that. And it's, anyway, that's a whole topic unto itself, which I find fascinating. And I think we mentioned it last week, is the cigarette industry, how they are completely evolving to the heat not burn. I know Altria has moving beyond smoking. And I know they talked about on the Dividend podcast last week, which I think, do you remember, was it Philip Morris? They said their tagline is like changing the world or making the world a better place.
Yeah. The Dividend Talk podcast. Yeah, it is Philip Morris or Altria, one of them, and they were just laughing how kind of silly that tagline is given their line of work, but to each their own, I guess.
Yeah. All right, let's see, getting caught up. Shamir again, especially when they get Timmy's or Starbucks. Oh, Tim Hortons. Yeah, and I used to know who owned Tim Hortons up there in Canada. I don't remember.
Yeah, if you can right now.
Are sector ETFs good for iron condors? Now, this is something I'm not familiar with. I know the term. Do you do iron condors?
I don't. I keep it really simple. I just do cover calls and cash secured puts. I don't do anything with the other ones. So sorry, I can't help there.
Yeah. So we'll wait for another question here. Anybody got any more questions? Shoot, whatever you want. Doesn't have to be about covered calls. It could be any dividend or stock related question that you have. Yeah. So I'm funny. You brought up Pepsi. I'll be getting my 93rd share this week. And it is funny, when I started this, A, I wanted a core position, and B, I wanted to sell covered calls on it. But now, after taking nearly 2 years to build this position, I don't want to just have it called away. So I'll probably be going the safe route and literally doing like a 1 to 2 week and maybe getting $5, $6, $7, just a little bit extra cash on that, because I took all this time building it. I don't want to
you don't want
to lose it all. Yeah,
for sure. Yeah, so I mean, I do those way out of the money, which is what is called when you pick a strike price that's very far away from what you purchased at. I do AbbVie, 3M, Johnson and Johnson. Just thinking some other ones I do. Prudential, MetLife, kind of do it across the board. Again, stable companies I'm going to hold either way, so I might as well get a little bit extra premium.
And you're collecting the dividends too, as long as they're not called away. Yeah, that's. Exactly. I don't think we touched on that, did we? That's duh. duh. Yeah, as long as whoever holds those shares, regardless of what the contract option is, whoever holds the shares in their account is getting that dividend. And
Hmm.
now there's strategies and things that play into that, but that's one more thing to remember.
Absolutely.
And let's see, Steve Straddle. Yeah, again, I've heard that, I've seen that around. I've never really looked into it. All I've ever done are just covered calls and cash secured puts.
Yeah, I haven't done shuttles either, but I understand that you're looking for a particular stock to stay within a certain range during that time. So your shuttle is you're picking a low end and a high end, and you're hoping that the stock stays in between. And if it does, you make money. But once it goes outside of those two, that's where it can go against you. So again, I keep it really simple. I can make 24 to 48% a year on my covered calls and cash secured puts. So why bother? In the way I look at it.
Yeah, yeah. All right. Couple more. Shamir again. Been adding to 3M. I have not yet. I will. There's a lot that I'm always looking. That's the problem. There's so much that I want to buy. That's At times I envy the ETF investors because you just put it in, set it and forget it. But
Yeah.
I'm looking for deals. I'm adding to my PepsiCo, and it's just, yeah. So I will. I'd especially like to see 3M drop into the 120s. I don't know if that'll happen, if I'll get my wish. What's your opinion on 3M? I don't know if we talked about it last week.
Yeah, so I have a lot of shares, probably a few hundred 3M shares. So I'm definitely not looking to add right now because it's kind of at my limit on how much I like to keep in each allocation.
Hmm?
Um, but it is a good price now. So every week I do a evaluation series, and 3M's been showing up on my radar as undervalued for the last few months actually. So
Yeah.
if you are purchasing 3M, it's a good time to do it as long as you're comfortable with the underlying business and everything that's going on with the company. Obviously, they've been around forever, but they are going through some headwinds right now. So you take a
Oh
look
yeah.
at the details.
And that is kind of one of the nice things about dividends that I've found out dividend paying companies is that they do offer kind of like that downward price protection, right? So if a company like Clorox is one that I actually, not last week, I recently bought another share or so, 132, I think, which of course I buy it at 132 and then the next day or two it's down to 127.
Yeah.
But the point is that these big blue chip companies, they're only going to fall so far before that dividend yield is so juicy that investors aren't going to pass that up, and then they can start that feeding frenzy and people come in and buy and it'll start pushing the stock back up. So
Yep.
that's all right. Let's see. Here we go. Here's an interesting one. Entropic Ape again finally got 100 shares of tea to do a covered call, but a little shy about losing the shares. Well,
Yep.
I would say it depends on what your long-term plan for those are, and
Yep.
if you where your average price is at, and how long you've been held. Well, it sounds like you just finally got them,
Yeah.
but
So
yeah,
there's certain companies that I don't want to lose the shares, and so I would never risk it by doing a covered call. Yeah, I might be able to make 10, 15, $20 all up front, but I at the risk of losing shares that I've built up over time. So if it's a company that you never see yourself not wanting to hold in your portfolio, just don't do a covered call on them. Just move on to the next company. So
absolutely.
if T is one of those, just ignore it. Don't do a covered call because as an options investor, there will be times where you lose your shares. It's going to happen. And so just be ready for it. So if it's something you're not willing to get rid of, don't even bother.
Yeah, and even for example, if PepsiCo is at, I don't know, 165 and I do something crazy like 185 2 weeks away, we don't know. Anything can happen, and it could jump up to $200 and I lose it. They
Exactly.
cure cancer or something with one of their food additives. I don't know. All right. And one more here from Terry again. If you want to buy 100 shares like Ford or XLF to have two sell covered calls, do you recommend in buying a covered call to buy the 100 shares first or just buy the 100 shares outright? What do you think,
Great
Jeremy?
question. So I like where you're going, Terry. So when you're looking to buy shares using an options contract, it actually wouldn't be a covered call. It'd be a cash secured put. You have the cash that you would be willing to buy the shares anyways, and you're just saying, okay, instead of just buying them outright, let me do a cash secured put. Basically, I am writing a contract, selling a contract, saying I am willing to buy someone else's shares from them at a certain price. And by doing that, I'm giving, as Russ said, the seller, the holder of the shares insurance that if the stock tanks, they're still going to be able to sell me their shares at the price that we've agreed to. So it's called a cash secure put. It works the same way, but it's in reverse. So instead of writing a covered call, you're going to write a cash secure put saying, okay, for Ford, I'm willing to buy 100 shares at $10 between now and the end of the month. And if it goes under $10, then you get the shares. But if it stays over $10, you keep your premium that the other person gave you, but you wouldn't get the shares. And so when you're doing that, it really depends on your timeline. If you're willing to wait it out to get the right price, the price you're looking for to buy those shares, then a cash secure put is definitely the way to go. If you like the price of the shares right now and you just want to get your 100 shares, you can buy them straight off the market and start your covered
Yep.
call process.
Yeah, yeah, and it's like the way I've heard it put is that when you sell a cash secured put, you're getting paid to wait for a better price.
Exactly.
So it's
But
yeah,
the downfall is you may never get that price. You may never get the shares, especially in the market generally speaking goes up over time. So if you're constantly trying to get a lower and lower price, but the market keeps going up and up and up, you
yep.
may never get those shares. Yes, you will get paid to do that process, but you may never own the shares. So just keep that in mind.
Which is one of the things that I'm not worried about, but with my Altria that I have it at 50, I'm actually rooting to get it. And I think I said ideally if this coming Friday, if Altria was at $49.50 a share, like I would be head over heels. I would get the shares. I still made money. Like that would be a perfect scenario. And we'll have to wait and see what happens. But yeah, like you said, we don't know what's going to happen. And again, Altria cures cancer somehow, and now their shares are $100 a share. And here I am waiting for $50 on Friday. It ain't going to happen. So, yeah, I don't feel as comfortable with cash secured puts as I do with the covered calls because I actually own the shares. Where now so perfect. Actually, here's a good example. Again, tie it into Altria. They go ex dividend on Thursday, which is 3/24, March 24th. So my contract expires, the cash secured put is on the 25th. I don't get the dividend. I'm not entitled to the dividend because I don't hold or own the shares. And the reason that I sold uh, that cash secured put was because I wanted to have a better chance that their share price is going to be down. Now, Altria's dividend is 90 cents a share. So on Thursday morning, this coming Thursday morning, Altria is guaranteed to open up down 90 cents a share, and they may quickly recover that. So I've seen it where it's been within a day or two. So
Yep.
I did that, and that's why I said I got Altria's dividend early. So I wanted to make sure I was getting at least 90 cents or $90 total, because that's what I would have gotten for the 100 shares that I had called away. So we'll see what happens. We don't know, but
So that
I'm
actually
kind of
brings up a
hoping.
good
Yeah.
yeah, sorry. That actually brings up a good point. When you're writing cover calls, I would highly recommend not setting a contract date that overlaps ex-dividend dates, because that's one of the main reasons people exercise an options contract is to take advantage of the dividend. So if you can avoid writing them when the ex-dividend date goes through, it guarantees you get the dividend for that company you hold. Same goes for earnings reports. It's not advised to hold an options contract during earnings. So if a company you have is going to have an earnings report next week, it's probably better to wait till after the earnings go through to write your contract. And earnings is the most volatile time for a company. It could go up, it could go down, but if you have a
Yep.
contract set for a certain price, it might blow it out of the water and you lose out on all those gains and you have to sell your shares at a lower price than what the market is. So I would highly recommend avoiding ex-dividend dates and avoiding earnings reports.
And I'll build off on top of that. The very first covered call that I sold was on AT&T, and I purposefully did my due diligence. I didn't want it to be right by the ex dividend date, so I sold it for 2 weeks after the ex dividend date. Right, 2 weeks after. Well, imagine my surprise that the shares were up just a little bit over the strike price. But imagine my surprise when the shares were called away the day before it went ex dividend, which was 2 weeks early. So that I
Yep.
learned a very important lesson
Mhm.
that people can exercise the options contracts pretty much at any time. And they
Yeah.
did that. So then they captured the dividend and they captured share appreciation, the upside. So it was a win-win for them. And there I am with
Exactly.
no AT&T dividend. And I was like,
Mhm.
oh, I
Yep, yep,
learned
yep. You
something.
just lost that exactly. So you just have to be aware of what's going on. You just don't write cover calls blindly. Know what's going on with a particular company. And an options contract gives the buyer the right and not but not the obligation to buy or yeah to buy those shares from you at any point during the contract. So there
Yeah.
was this point when if you still have 3 weeks left, if that buyer wants those shares, they have the right to get them whenever they choose. And a lot of people do choose to get it right before the ex dividend date so they can take advantage of getting that dividend. So just be aware.
Yeah. Yeah, it sucked, but again, that's how we learn. It didn't
Yep.
break the bank. It didn't kill me. I just missed out on one dividend cycle and a little bit of share appreciation, but I still won because it was over my average price. I still got paid for the contract, so I didn't lose any money, which is again, it really can be a win-win. But like we've said over and over, is that what you do miss out on, or potentially is the you're capped on your upside.
Yep.
But it's something we look at. Well, we got a few more minutes. We're doing good, man. We got through a lot.
Yeah, we did.
I'm
So
I'm
cover calls are
excited.
great
Yeah.
because you have three possible sources of income with a cover call. You have the if you do a cover call and a dividend pair, you get the dividends. So that's one form of income. The second form of income is the options premium that you get up front. And then the third part you get is the capital appreciation. So if you have a share at 49.50 and you sell the $50 contract, you're making 50 cents per share if the price goes up to $50 or more. So you have three sources of income on one trade. So it's a great way to up your returns and give you more cash that you can use to go buy more investments. So it's a good
Yeah.
deal.
Yeah. No, it's fantastic. And again, I was thinking about when people are worried about losing them, then this whole game, if I could say one thing, do what lets you sleep well at night. I mean, this is why I found dividend investing, because I tried penny stocks, I tried swing trading, and there was times when pre-market opens, I was up at 4 o'clock in the morning looking at my phone, waiting to see what the day was possibly going to
Yeah.
bring. And I lost so much sleep, and I was like, okay, I can't do this. Something needs a change. And yeah, I'll just tell the 2 second story. My grandfather was an investor, but never really talked much about it with me. But I did remember him talking about his dividends he would get from AT&T, Disney, and Walmart were three ones I specifically remember him saying. So there I was at 4:30 in the morning, frustrated, tired of losing sleep and money, and yeah, I just Googled dividends, and boom, that's all it
Yep.
took. That opened the rabbit hole, and I really started learning about them. That's all it takes.
Yep, dividends are definitely my focus in the market. But writing these cover calls and cash secure puts, I think I joked previously, is like rocket fuel or jet fuel for your dividends. So it's a great way to make some extra money while still being conservative. One thing I forgot to mention earlier is even the SEC and other regulators find that covered calls are a very conservative strategy. So conservative that they will allow you to do in a retirement account. And a lot of things you can't do in retirement accounts. So even though it might sound confusing, it might sound foreign, all the different language that we're using and how to do it, if you follow the basic guidelines that we talked about, setting the strike price higher than your cost basis, being conservative, don't chase
Yep.
the premium, is a very conservative option that you get a little extra money to do more investments. So definitely, I would recommend everyone at least look at it, look into it. As Rusty said, look on YouTube, find some people you can trust
Yeah.
out there, get a sense on what their strategies are and what their process is, and go slow. Start off with a share of stock or 100 shares that you feel comfortable with. Do a strike that's way out of the money so that You get a chance to experience what it looks like without risking your shares, and then build up your comfort level from there. Don't feel like you have to go all in right at once.
Yeah, absolutely. I mean, that's right. Get your feet wet. Like you said, you can literally get $5 for doing something that's just very, very unlikely to hit or get called away. And it's
Yeah.
just, what are you looking at this week? We're wrapping up here. Anything
Yeah.
interesting? What's on your
I,
mind?
I'm trying to stay very uninteresting this year. So I'm focused on my ETFs this year. So again, I plan on making investments in SCHD, Schwab's Dividend ETF, VYMI, are the Vanguard International Dividend ETF, BST, which is a technology-based covered call ETF, and then Devo that we've been talking about. So that's the dividend-paying covered call ETF. So I keep it consistent. I put a set dollar amount every week, and I just go on with my week. Try and keep it real simple this year.
Yeah, I did. I did, and I'm going to do a video on it. I don't know if it'll be this week or next week. We did start a new sub account, and in it, I bought 2 shares of SCHD and 1 share of DIVO.
There you
So,
go.
I, I like it. I was looking at the exposure at what their holdings are, and I just think it's really cool that you just buy this one ticker and you're getting instant exposure to these fantastic companies that are in it. And obviously, you're paying a small expense ratio for it, but yeah, I mean, it's just it's so much less work. It's a lot less work, and it's easy. It's almost too easy to do, I guess.
Exactly. Yep.
Yeah,
So
and then yeah, go ahead, go ahead.
no matter what's going on in the market, you can always find an ETF. So if you don't know what to buy, something like SCHD or Devo is a simple way of just getting money in the market and continuing building that snowball, if you will, of dividend payers.
Yeah. Devo, whip it. Oh, by the way, speaking of 80s, I forgot. Anybody know what this is from?
Nope.
You don't know? Oh
No,
my
no.
God. I'll give it just a minute. I don't even know if anybody's watching. I mean, I think a couple people might have fallen asleep here. Let's see. I don't know if I don't know, maybe the chat's broken. I haven't seen anything pop up in a minute. Yeah, that is actually the Regal Beagle cocktail lounge from Three's Company.
Mhm.
I don't even, it sounds like that's, do you want to give away your age? I don't know how old you are. Do you?
Sure. I'm 40.
Oh, yeah, I'm 44. Well, I'll be 44 next month. Yeah,
Yeah.
you don't remember Three's Company with Jack
I
Tripper and
remember it, but I wouldn't have.
oh, you didn't remember Regal Beagle. I got you. I got you. Yeah. No,
Very,
it's
very
weird. I
cool.
don't know. It's my little weird thing. It's I was watching the as a kid. I didn't know what it was. A single a guy living with 2 girls. My grandpa used to watch Benny Hill. Remember Benny Hill?
Mhm.
Yeah. Now I watch it, I've seen it now. I'm like, oh, that's why Grandpa was watching Bunny Hills, the half naked women on there. Oh my
Yeah.
gosh. Well, I guess we can end it a little early. I was just telling Jeremy that I got up today and talk about supercharging or turbocharging your dividends. I got up this morning at 4:45 and I was on site at the job before 6 a.m. It's time and 3/4. And you know what? That's more money. And I'm able to buy more passive income just that much quicker. But I just saw something pass up here. Yeah. Matt says he's still awake, just slow typing. Thank you, Matt. And do I have a WKRP in Cincinnati shirt? No, I don't. I do want to go to Cincinnati. We are going to Cleveland in 3 weeks to see the Christmas Story house. So nice. What do you mean I'm too young to remember Three's Company? No, not at all. Terry, I'm gonna be 44 at April 20th next. Yeah, almost exactly. What day's today?
21,
The
I think.
20th. Today's the
20.
20th. There you
There
go.
you
See, 4 weeks. 4 weeks. I'm gonna be 44. All right. Let's see. Shamir, we'll end with you, Shamir. He loves Bunny Hill. Has the DVD set. What are DVDs?
go.
Oh, you know what? Last thing, I'll end on this. I was listening to a podcast and one of the guys on it is about our age, and he said his 6-year-old son was asking his 9-year-old daughter what's friend book. He didn't know what Facebook was. Now, as somebody who just bought one share of Facebook at $199 to play around with it, that kind of made me feel like, ooh,
Maybe.
I don't know. You're on Facebook, so I wanted to ask you,
Yeah.
and we'll end with this. Do you feel like Facebook is a dying platform? Do you feel like it's changing or going away? What are your thoughts on Facebook?
I think it's going to be around for a long time, but no, I think that as the younger generations keep coming up, it's going to be less and less relevant. So obviously they have Instagram and what's it, WhatsApp or whatever
Yeah,
their
yeah,
message is. So I think there's alternative things that they can take advantage of. And obviously they're going into the metaverse pretty hard. So if they make that happen, then obviously that's a huge growth driver for them. But yeah, I hear it all the time that younger people aren't using Facebook, and so it's something to consider for sure, for sure. And
yeah,
all of us old people, quote unquote, you're still on it. It makes them even less wanting to be on it. So,
yeah. Well,
but
from what
they
I
do
know,
have.
Facebook owns Instagram, right?
Hmm.
Yeah, so Facebook owns Instagram, and all those old people, all the boomers are on Facebook. Well, who has all the money right now? It's all the
Hmm.
boomers. It's all us old people. I'm not
Yeah,
on Facebook though. I probably should, but anyway, so I guess we'll end it there. Thank you for coming on again. I really do
yeah,
appreciate it. This was
yeah. Thanks
really
for having me. Yeah,
entertaining and informative for me. I hope everybody that is watching this in the future and watched it right now will also get something out of it as well. So, hey, until next time,